So over my years of trading, I've witnessed time and time again that price doesn't move randomly, and it leaves clues behind of where price is going. And if you understand these clues, then you can stop chasing trades and start anticipating where price is likely going. So today I'm going to talk about fair value gaps and inverse fair value gaps. So a fair value gap is basically when price moves so fast with strong momentum that it almost leaves behind a footprint of an area where you can clearly see that there was an imbalance between buyers and sellers, right? And as you can see here in this example, this is a fair value gap. To make this as simple as possible, what you are looking for is 3 candles. I'm focused on the first candle and the third candle, and I'm checking to see if there's space between them. For a bullish fair value gap, as you can see here, the high of the first candle and the low of the third candle do not touch. There's a space between this, and that's the fair value gap. And it's important to understand that we're using the wicks and not just the bodies. So as you can see here, if the wicks don't overlap, then that's the gap. Same thing on the bearish side. As you can see here, on a bearish candle, if the low of the first candle and the high of the third candle do not touch, that space is your bearish fair value gap. So on both bullish and bearish markets, if the wicks touch or overlap, then that means there is no gap. So to keep it simple, check the candles on each side, and if there is space between the wicks, that's your fair value gap. Now, why are these gaps important in the way that I trade? Well, when it comes down to how price moves, price doesn't just move in a straight line. It expands and then it retraces. So when price moves aggressively and leaves one of these gaps behind, it will often come back to that area later. As you can see here, price moves away strongly, leaves behind this fair value gap, and then later, price comes back into that same area. And a lot of times, price will respect that area, fill the gap, or retest just a small portion of the gap, and then continue in the same direction. And these are a great tool to use because instead of chasing price, I wait for price to come back to me. Now here's something important to understand. Fair value gaps don't just exist on one time frame. They exist on every time frame. Like as you can see here, this is a higher time frame gap on the 1 hour chart. And inside of that, on the lower time frame, you can see smaller gaps forming as well within the 1 hour candle. So the market is constantly moving in imbalance on every level. And once you start seeing that, everything starts to make more sense. Now, another important thing to note is not all fair value gaps hold. As you can see here, price comes back into the gap, but instead of respecting it, it breaks straight through. And when that happens, we get something called an inverted fair value gap. And this is where I personally like to build my entries. Now, of course, I'm not just blindly taking these gaps. I'm also looking for other confluences. Like for a simple example, I'm looking for a sweep of liquidity somewhere. Then I look for an inverse fair value gap for my entry. But for the sake of this video, we're just going to talk about the fair value gaps and the inverse fair value gaps. If you guys want to understand my full model, check out my CRT breakdown video or click here to watch it. At the end of the day, this isn't supposed to be super complicated. All you're doing is you're playing into the idea of not chasing price and you're letting price come back to you. Then you execute based on your strategy. I personally like to take reversals. So I wait for a key level to be taken, then I look for an inverse fair value gap as my entry, and it's that simple. Now let's go to the charts and I'll show you some real examples of fair value gaps and inverse fair value gaps, and I'll break it down even further. Okay, so right now I'm on the 1 minute chart, and I am in replay mode just so I can kind of walk you guys through how I use these fair value gaps and inverse fair value gaps, as well as liquidity levels and stuff like that, to kind of walk you guys through how I trade and how I utilize these fair value gaps every day so I can get possible good entries for my trading. So what's the first thing that we notice right here in live price action? We see a fair value gap right here, right? Now, why is this a fair value gap? Because the high of the first candle does not touch the low of the third candle right there, right? So if we zoom in, we can clearly see that these do not touch, and that's your gap, okay? So we'll go ahead and label this a fair value gap, okay? Now, I'm not doing anything yet, but before we start marking out all these gaps, we need to kind of have like a little bit of a bias, right? So obviously we're trending down. We can totally see that we're making higher or lower highs, right? So we have a lower high, we have a lower high, a lower high, a lower high, and it just keeps going lower, right? So I'm really only interested in selling positions, right? I'm only looking for shorts. But in order for me to take a short position, I need some kind of a sweep of liquidity somewhere, right? So what's the liquidity? Well, we can see right here that we have these equal highs, right? So there's some buy-side liquidity right there. And then this one's obvious buy-side liquidity. And then we also have some buy-side liquidity up there. And I don't want to go too far because I'm only going to kind of focus on these areas right now. If price does come all the way up and start sweeping this liquidity, then I'm kind of going to switch my bias a little bit because the market is definitely likely flipping bullish, right? So we got a couple of these key levels marked out because when I take my entry, I don't want to just be taking them randomly on these fair value gaps, right? I want to have some kind of a sweep of liquidity. That could be buy side, sell side liquidity. That could be an hourly high or low, a 30-minute high or low, 4-hour high and low. Anything like that, any kind of key level that I'm looking for to take my entry. So I'm not doing anything yet. I'm just marking out this gap, and then that's just something that we're going to pay attention to later. Okay? So let's go ahead and advance the chart a little bit, and we'll see what happens. Okay, so one important thing to note. We did come down here and fill this fair value gap. So that means this fair value gap got respected, right? So price comes up, we create the fair value gap, then we come back down, we fill it to grab orders because there was a lot of buyers that pushed the market up right there, and a lot of them got left behind. So the buyers kind of like to let the sellers sell a little bit to bring the price down, and then the buyers step in, and then they push the market higher, right? Now, a lot of people might say, well, why didn't you take this fair value gap as a trade, right? Well, I typically trade inversions and we didn't get an inversion. This just came down and filled the fair value gap. We did not close beneath the fair value gap for it to be considered an inversion. So I'm still waiting. But as you can see, the buyers did come up and push the price up to this buy side liquidity that we had marked out. So you can keep this fair value gap. For the sake of the video, I'm going to go ahead and delete it, because we do have a new fair value gap right here, right? So that right there, buyers pushed the price up, created the gap, same thing, price comes down, buyers step in, push the price up, creating an imbalance in the market. So let's go ahead and mark this a fair value gap, okay? Still not doing anything yet because, like I said, I need some kind of sweep of liquidity. Right now, this liquidity is the closest to the live price action as well as up here. So let's see what happens. Okay, and then as you can see right here that the buyers did come up and sweep this level. So now I'm really interested. Are the buyers going to continue to push the price higher to possibly take out this liquidity level, or are they going to reverse it? Either way, I'm okay. I'm okay if they take this level or they only take this level. It doesn't matter to me. I'm just looking for, at this point, because I'm bearish, a inverse fair value gap for my entry, right? So let's see what happens. Okay, so right there, perfect example. Buyers pushed up, they took out the liquidity right there, and then they started pushing the price back down. Okay, so now there's a battle going on right here of the sellers wanting to push the price down, and then the buyers wanting to push the price up, right? So let's see what happens. Okay, now I'm really interested in this trade because we have a fair value gap inversion now, right? So now we can go ahead and change this to an IFVG because that stands for inverted fair value gap, right? So now, because I'm bearish and we swept this buy side liquidity over here, now I'm interested in taking this trade, right? So we can go ahead and do a sell stop down here because we did get the body of the candle to close below this inverse fair value gap, and we can just do a little bit above the fair value gap inversion. If you want to be a little safer, you can go above the recent swing high, but you want to at least try to go for a 1-to-1. I typically try to go for a 1-to-2, which would be down here. But for the sake of this video, what I could do is just take profit right here, because same thing. The sellers now are going to want to take out this sell side liquidity, right? So we have sell side liquidity down here that we can mark out. So there's a couple ways that you can do this, right? You could either take full profit right here at this recent swing low, or you can take partials and then move stop to break even. That's going to be entirely up to you. Okay, so for the sake of this video, let's just see if we can at least get the 1-to-1. Okay, and as you can see here that we did in fact get the 1-to-1. Now, if you wanted to go for a 1-to-2, what you could do is you can move stops to break even at this point, and now you're at a risk-free trade. So what you could have, let's say if you were taking 2 contracts on the NASDAQ, you can take 1 contract off right there, move stop to break even, and then try to get a little more out of it going for a 1-to-2. So let's see what happens. And as you can see right here, that the price did come up and stop me out on break even, which is totally fine because I already took a little bit of profit off the table, and that was just a risk-free trade at that point. Okay, so let's see what happens next. Now, another thing to pay attention to, even though I did get stopped out at break even, that doesn't mean I can't re-enter the trade, because the market's always just going to kind of move in waves, right? So sometimes you get stopped out, sometimes this would have flown down and hit that 1-to-2 like really fast. Sometimes it's easy, sometimes it just kind of like chops around in that area, you know, like you never know what's going to happen. But right here, we did take out this sell side liquidity right here, right? And then the buyers started pushing the price back up, as well as creating another fair value gap right here, right? That we did come back down there and fill. So let's see what happens next. Okay, now they push the price back up and we have another fair value gap right here, right? So I'm just always kind of keeping these fair value gaps on my radar just to see what happens, right? Okay, and then right there, we did get the fair value gap inversion. So if you wanted to, you could have re-entered that trade right there for another short, or if you missed this one, you could have taken this one. I probably wouldn't have personally taken this one just because we never got the sweep of liquidity, right? This just decided to reverse right there. If it took out this recent swing high and then created an inverse fair value gap, then I would probably be interested in the trade. But for the sake of the video, let's see if you would have got at least a 1-to-1, setting your sell position right here at that the close of the candle that inverted this fair value gap up here. Okay, and that one would have gave you a 1-to-1. So you can kind of see how I'm using these gaps, right? Very simple. We have a sweep of liquidity, we have an inverse fair value gap, and we take our trade, and then we're just going to the next key level, which is this recent swing low. Same thing right here. Push the buyers push the price up, and then we inverted this fair value gap right here, and then we took our sell position and we hit at least a 1-to-1. So because we're kind of in no man's land over here, if you wanted to go for another key level, you would have to zoom out to the higher time frame just to kind of see where we're at. So you can still see that we're kind of in no man's land a little bit. So let's go to a higher time frame, like the 30-minute, see if we can see anything right there. And we definitely don't. So let's go back to the 1 minute. Now the reason why I zoomed out like that, and I wanted to show you like what the next key level would be, because those are areas that I'm potentially going to set my my take profit at, because like I said, the market is always just seeking liquidity somewhere. It's always going from level to level, from level to level. So right here we swept these highs and then it went down. Right here we swept these lows and then it went up. So if you wanted to go against the trend, right here would be a fair value gap, right? So we swept these lows, here's your fair value gap, price comes up, we inverted the fair value gap, and if you wanted to go against the trend, which a lot of people do, that would have got you a long position right there, right? So you're just kind of using these gaps as points of interest where you can buy and sell and take your trade. All right, so let's go to another example. All right, so right now we're on the 5 minute just because I want to show you guys that every time frame has some kind of a fair value gap. You don't always have to use the 1 minute. I just like to use the 1 minute because the 1 minute is going to be more of like a sniper entry based off of an overall trend of the market. I'm not just staying on the 1 minute and finding these fair value gaps and inverse fair value gaps because you are going to get a lot of false signals, right? So a lot of the times I like to use the 5 minute, the 15 minute. It just depends on if you're more of a scalp trader, day trader, swing trader. There's a lot of different ways you can use these fair value gaps. But right now we're just going to try to find an entry on the 5 minute chart. So right now it's kind of a choppy market. The market conditions haven't been that great lately. But what are some things that really stick out? Well, we have all this buy side liquidity up here, right? And then we also have this buy side liquidity right here. And we have some buy side liquidity up there. And then we could also mark this one if we want. But you can clearly see that we have all that liquidity up there. And we are trending down a little bit, right? Because we have a high, we have a lower high, a lower high, a lower high. Not the best conditions, but we are in fact making lower highs. So I am still bearish, right? So let's go ahead and zoom in to our live price action and we can see where we're at. Okay, so right now I don't see any fair value gaps, right? But we did come down here and sweep these lows. So sellers pushed the price down, we swept the lows, and then we're starting to move up. So that tells me that after we swept these lows, the likelihood of us going up and taking out these highs that we just marked out are high probability now, right? So let's go ahead and advance the chart and we'll see what happens. Okay, as you can see, the buyers did step up and started pushing the price higher. And what did we get? We got a fair value gap, right? Remember, the first candle's high does not touch the third candle's low, so that is a gap, right? So we can go ahead and mark this one 5 minute fair value gap, okay? So I'm not doing anything yet. I'm just paying attention. That is a important area for me right here because a lot of buyers stepped up and really pushed the price higher, right? So now that we have our two key levels right here, then we have another one up here, and we could also mark that one too if we wanted to because you can, not obvious, but you can clearly see that it was a lower high on a smaller time frame, right? So let's see what happens next. Okay, now as you can see right here, we have another fair value gap, right? This is still a 5 minute fair value gap because I'm staying on the 5 minute chart. Okay, now we can go ahead and keep this one or we can get rid of it. The reason why I get rid of them, I still keep them visually, but I like to focus on the first fair value gap as an inverse fair value gap as my entry after we sweep a key level of liquidity. This is a key level to me right here. We have these two equal highs, right? Relatively equal highs, they like to call it. Okay, so we have these equal highs. We came up, took out those highs, grabbed some orders, meaning they stopped a lot of buyers out because there was a lot of breakout traders right here that they wanted to buy to go up to that next key level, right? So they wanted to buy and then hopefully take out that level. But you can, since I'm bearish and I don't really like to go against the trend, I'm waiting for that sell position, right? It's all about being patient. Okay, so right here we do have a 5 minute fair value gap. After sweeping the liquidity, we did get the candle of the body to close below the 5 minute fair value gap, and that's enough for me to go short, right? So we can do stop losses, same thing, either slightly above the 5 minute fair value gap, or we can go even higher. And then this one would actually work out perfect because I like to go for a 1 to 2 risk to reward ratio typically. But right here, same thing. You can move stops to break even. You can move stops to break even right here at this fair value gap, or you can just let it you can let it go all the way down to your 1 to 2 because this is our next recent swing low right here that sellers might want to come down and push the price all the way down there. So let's see what happens. Let's just try to go for the 1 to 2 and we'll see if this trade plays out. Okay, as you can see, we did buy in on the position for a short and we'll see what happens. Okay, so right here would be your partials or your break-even stop. I'm not going to do it on this one. I'm going to try to go for the 1 to 2. That's all going to depend on you and your risk management. Okay, so if you did have a break-even stop, which it does happen, obviously it would have stopped you out. Since I'm not doing break-even on this trade, I'm going to just let it run. And as you can see right there that trade did play out perfectly because we have the sweep of liquidity. We also have the inverse fair value gap. We did inverse it and do the short position. We are in the position and then the sellers stepped up and started pushing the price down lower, right? Now, if you missed this one, you could have also taken this position because this fair value gap that we marked out earlier is now an inverse fair value gap because we got the body of the candle to close below the inversion. So right there, you could have took a short position and same thing, you could have went down to the next key levels of liquidity, which would be that area, and that trade would have gave you a 1 to 2.5, right? So you can kind of see how I'm using these fair value gaps and how I trade them. Now, like I said before, I'm not just blindly taking these inverse fair value gaps. I'm using these key levels as areas of reversals, right? So buyers pushed up right here. They took out this area of liquidity. We got the inversion. And then where's price going to want to go? It's going to want to go down to another key level, which is now down here. Or this fair value gap would be another key level. That's why I said earlier, if you want to move your stop to break even, because the buyers really could have pushed right there and then pushed the market higher to go to this next key level right there. So that was a good break even point. For the sake of this video, I did do a 1 to 2 just to show you that you don't always have to do a 1 to 1. So that's going to be it for today, guys. I really hope that these fair value gaps kind of make sense. You know, there's a lot more to it that I can go in just hours and hours of detail of more about these fair value gaps, but this is just the most simple way I can explain it and show you guys how these work. And if you want to know more about my 2 Trades Pro indicator and my Smart FVG indicator that automatically marks out all these key levels, highs and lows, higher time frame highs and lows, buy and sell side liquidity, as well as marking out these inversions automatically, you can go ahead and click the link in this video, and we'll see you guys on the next one.